What's up, everyone? It's Karthik with MoneyVest. So I am back in Dubai. I had one of the best times in Tbilisi, Georgia, spending about a week over in that beautiful country full of rich history and stunning landscapes. Went to a lot of different places up north and in the east and the west as well. Definitely recommend it for anybody who wants to take a week off, go to an amazing place with great weather, great people, and amazing landscapes and great wine. So definitely, had one of the best trips of my life. But now we're back to work here. September is here. We got lots of data and a lot of things to break down in this update because it's been a longer weekend because of Labor Day. And it's starting to feel really boring. So I wanted to definitely come out with this video to help you prepare for the upcoming week and the month of September as well. So make sure that you drop a like and subscribe to the channel, and also do share this video with your friends and family and other traders, investors. It really helps us grow our channel and bring in more people in the community so we can have more lively discussions and engagements. But this right here is the calendar that's coming up for next week. It's going to be a shorter week. So Monday, of course, the markets were closed, but it is a very important week because we do have the unemployment situation coming out. In other words, unemployment numbers are going to be coming out in the first Friday of the month of September. That's going to be for August. So again, it's a bit of a lagging indicator. We're going to get that on Friday at 8:30 a.m. Eastern, and I will be live to cover those numbers, of course. And prior to those numbers coming out, we've got the JOLTS numbers on Wednesday, September 4th. At 10 a.m. Eastern, we got the factory orders. We got the Beige Book coming out at 2 p.m. We also got the PMI Manufacturing Index, ISM Manufacturing Index, construction spending. And then Thursday, just like every week, like clockwork, we've got the jobless claims numbers and the ADP employment numbers also coming out at 8:15 with the PMI Composite Final and ISM Services Index. A lot of really important economic data points scheduled for the upcoming week. Now, coming over to the FOMC meeting is also scheduled for September 18th. So we've got unemployment this Friday, we've got inflation next week, and we've got the FOMC meeting the week after that. So September 18th, in just about 16 days, we've got the next Federal Reserve meeting and the chairman of Jerome Powell giving us a speech in the press conference, as well as the summary of economic projections also scheduled to be released. JOLTS numbers, the consensus 8.1 million. Versus the prior number of 8.18 million. So job openings expected to come down. We've got another spreadsheet, which I will be breaking down in a different video, which goes over the job openings, the unemployed persons, and calculates the unemployment rate as well. And the PMI Composite Final at 54.1 is the consensus, and 55.2 for the services index. Now, when it comes to employment situation, we are expecting about 160,000 job additions, with unemployment rate coming down from the prior 4.3% down to 4.2. So that again is going to be giving the markets a lot of confidence that soft landing is indeed possible. If this number accelerates above 4.3, so gets up to 4.4, 4.5 or higher, well, that is not going to be good for the markets. And I'll tell you why. Because yes, from a quantitative easing standpoint, from a Federal Reserve's rate cut standpoint, that is still going to be bullish because the markets are going to become more optimistic of a rate cut. Right now we're pricing in for 25 basis points, so that's exactly what the markets are pricing at the moment. I'll go over that in just a minute. But if we actually see that acceleration from 4.2 to 4.3, that's where we are now, but 4.4, 4.5 or higher numbers, well, the market's going to quickly switch from 25 to 50 basis points in anticipation of a recession. And we already know that recessionary environments are not great for the markets. We actually tend to see much longer lasting and more severe bear markets during times of recession than we do in a non-recessionary environment, and when there is rate cuts happening during a time when there's not a recession, which again I'll go over in later in the video. So 4.2 is the consensus expectations, but if this number starts to increase a little bit further, we're expected to see 4.2. But if we go up to 4.4, 4.5, that's obviously not going to be great news. And some people may argue that that's great from a market perspective. Rate cuts are going to accelerate, but from an economic standpoint, that's not going to be good news, in my opinion, for the market. So short term, medium term, the outlook continues to be a little bit more on the weaker side. And again, that's what I'm preparing for. In my previous videos, I mentioned that I'm in the process of raising more cash and increasing my cash exposure back up to 20, 25, as much as 30%, while at the same time selling calls and selling puts to generate more income and getting ready really for the end of September to the beginning of October period. And October really is, from a seasonality perspective, going to be a month which we have to be a little bit more careful about, right? It can definitely blind blindside investors. If everybody's too fixated on September being one of the worst months for the year, for the market, October tends to really be the bottom for the market. So the buying window really is going to be occurring in October, not so much in September, is my viewpoint going into the next few months here. Manufacturing payrolls expected to decline by 2,000. 136,000 is going to be for private payrolls, and average hourly earnings at 0.3% and average hourly earnings year over year at 3.7% as well. Now, this right here is the unemployment rate, as we have already discussed. Prior to every recession, we do see the acceleration to the upside for unemployment rate, which again should not come as a surprise because that's one of the indicators that results in recession to begin in the first place. Is when we see a lot of people out of jobs, a lot of companies doing layoffs, and this right here is where we are, slowly and steadily accelerating higher. So if this number continues to move higher, which obviously is a possibility, it's not out of the question yet, is going to really indicate that the recession is indeed here, and that's going to really force the NBER, the National Bureau of Economic Research, to declare a recession. Now that also has to accompany with a quarterly decline on the GDP on 2 consecutive quarters in a row. Now, this right here is the earnings calendar. We do have some very, very prominent companies like Zscaler reporting, Copart, and we've got HP. We've also got companies like Broadcom, one of the top 10 companies in the market in terms of market cap. We got Kroger also reporting their numbers on Friday. We got DocuSign reporting on Thursday. That's going to be after the bell. So those are some pretty notable companies reporting their numbers. I will be live for Broadcom and for Zscaler earnings as well. Now, when it comes to Labor Day, I also wanted to take a look at how the markets perform after the Labor Day weekend all the way through the year's end. And you'll notice the markets tend to actually be positive most of the times, with S&P 500 rising about 70% of the times, averaging about a 2.8% increase. The Dow Jones rising 72% of the times, gaining about 2.7%, and the Nasdaq, while increasing more on average by 3.4%, has a lower probability for it to be higher of only 68%. But in more recent history, you'll notice that we've seen majority of the times markets push higher after the Labor Day weekend all the way through the year's end. And coming off of the Labor Day weekend, we wanted to take a look at seasonality around the holiday. So this is going back as far as 1928, and the near-term performance actually has been weak after the Labor Day, with declines that Tuesday after the holiday and the week after and 1 month after. By New Year's Eve, though, the markets tend to be a little bit higher. So this right here is the average performance of 1.24% after the Labor Day weekend all the way till the end of the year. However, the 1 day after, 1 week and 1 month is not that great. So again, this is kind of playing a bit of a role into the September seasonality as well, and going into October, as we already know that September is one of the worst months for the year for the market, and as we know that the probability of us going higher is below 50%. So that is really what is playing a role here in the September seasonality, kind of coming off of that Labor Day weekend. But the markets tend to, of course, push higher in October, November, December, more specifically November and December, and that's why that seasonality is so strong towards the back half of the year and towards the fourth quarter as well. So that's something to keep in mind. That's exactly one of the reasons why, again, I'm preparing you guys for what could be another September, October event for the market, and be ready to deploy cash, be ready to buy more individual stocks. You really need to have a plan in place prior to the sell-off beginning. Why? Because the buying window is not that big. Buying window is really, really small. And as we witnessed on August 5th, the Monday, August 5th, the buying window was really just for a few hours. So if you didn't really have a plan in place, you didn't have cash ready, you didn't have a shopping list of stocks you really wanted to buy, you most likely missed out on a lot of opportunities with a very nice V-shaped recovery back higher, with many stocks up 20, 30, 40, 50%. So it's really getting ready. I mean, the thing is that during the sell-off, it's really just all about execution. That's it. Like, the planning has to be done prior to the sell-off. So it's not like you can't begin to plan when there is a sell-off. You need to plan prior to the sell-off, because when there is a sell-off, you're not planning. You're just placing trades. You're just executing. And that's what all the homework is for, right? You're doing all the hard work. You're putting in all the legwork prior to the sell-off, and then when there is a sell-off, you're just expected to place trades. That's it. You're just expected to place limit buy orders or sell puts or whatever it is that you need to do in your strategy. But a lot of the work has to be done on the back end in order for you to be ready and get ready for when the time actually does come. So coming over to S&P 500's performance after the Labor Day, another really interesting statistic, and this is performance before. So if the markets are higher in the week prior to Labor Day, which we were in this case. You'll notice the Tuesday after, on average and median, has been down. So again, tomorrow the markets could potentially be down. 27%. We've been positive. But again, 63% positive 1 week later, and 1 month later, we are 63% positive by an average median gain of about 0.24, 0.49%. And this right here is going to be 81% performance by the end of the year, by an average of 3 to 1.73% as well. I guess they are looking at the only the weeks that we were higher prior to the Labor Day weekend, and then what the performance was. And this is accounting for pretty much all of those years, going back as far as 1928. Now, this right here is also something that we have to keep on our radar, which is the uninversion of the yield curve. So every time you've seen that uninversion take place, a recession has of course followed, because it's not so much of the inversion of the yield curve that triggers a recession. It is really the uninversion, because we're on the way back up is when a recession actually begins, and we're very, very close. And this is the 10-2 on the treasury bonds, and we're just about negative 0.004%, so practically back up to break even. And if that continues to accelerate, meaning the long end of the curve is once again starting to yield higher returns compared to the shorter end of the curve, and we're back to a normal functioning market with the bond market, and that of course is going to be suggesting for some more caution. Now, another reason why I do believe that there is some serious weakness in the economy that is not really showing up just as of yet is because of the earnings from companies like Dollar General, right? So you've got big retailers like Dollar General, and Dollar General is actually one of those stores which is a discount store in itself that people go to buy discounted items, right? So 25% down Dollar General stock after cutting outlook and blaming quote unquote financially constrained customers. So they essentially said that lower income customers are struggling in this economy. And the company now expects fiscal 2024 same store sales to be up 1% to 1.6. That's lower than what they were expecting earlier. And the CEO, Todd Vesos, said, while we believe that the softer sales trends are partially attributable to a core customer who feels financially constrained, we know the importance of controlling what we can control. However, he has acknowledged that the company has more work to do. Dollar General has said that it needs to improve its stores and how it handles inventory to curb losses. But this again is quite telling in terms of the shape and the strength of the US consumer. And a lot of that, in my opinion, has come from the back of debt, credit card debt. And I feel like the reason why this time around it's taken a much longer time period for the US to really realize the pain of higher interest rates, or really just kind of, got to go through that weakness of economic weaknesses that we've witnessed before, is because of debt in the first place. What you'll notice is the retail sales here, they continue to be very, very strong. We're sitting at over 702 billion. They're starting to level off just a little bit, but they have been on a very nice, consistent, stable acceleration to the upside. Every time we've seen a recession, this is only going back as far as 1992. We've seen pretty stark, or I should say sharp declines in retail sales every time we've seen a recession. But this time around, not at all. We're continuing seeing that uptrend and a little bit of acceleration, although I would like to point out that we are flatlining a little bit. And that's primarily because of the number of credit card accounts and the credit card debt. And that's that's how I feel, because if you take a look at where we are, $1.1 trillion in credit card debt, with all accounts in the US sitting at almost 600 million. That's almost twice as much as the population of the US, meaning that there's almost 2 credit cards floating around in the US per person, right? With overall balances of well over 1.1 trillion. So what's happened over the years, and again, you'll notice that in the last couple of times, we've actually seen it top at the same level, right? Same number of credit card accounts and same number of balances, topped out at the same level, right? This is going back as far as 2008 and in 2020. So in a 12-year period, we didn't actually see any increases in credit card debt or any increases in total accounts. But what really exploded after the pandemic is this number right here. More credit card accounts, higher credit card debt, and that's what's fueling the economy. That's what's really is been over here. That, like, really what this is, it's like this over here, this chart is a product of these two charts right here, because more spending more borrowing has led to higher retail sales, which has led to higher productivity, higher margins for businesses, and more growth, right, for the overall economy. And that's what's really been keeping earnings higher, keeping margins higher, keeping pricing power higher. And as a result, it's kind of giving us an illusion that, look, the economy is great. But when in reality, I mean, there's really real struggle that's happening for American consumers, as Dollar General has really just pointed out. And there's been a lot of other, indicators as well. But this right here is another really interesting chart looking at the U.S. savings rate, right, which is also really, really low. I mean, we're looking at 3.1%. It's come down from well over 4 or 5%, and it's back down to the same levels what we witnessed back in 2022. And historically speaking, again, this is one of the lowest levels we have coming down to since 2007, 2008. And this is to say that for every $100 that U.S. consumers are making, they're only really able to save $3.10. $3.10 is what they're able to save for every $100 they generate in income. So $96.90 is being spent. On top of that, they're taking on more credit card debt in order to fund their lifestyle or live, just to get by because of how high inflation and everything else is. So I think those are some things to really consider when you try to understand, okay, how long can this economy really go? Look, I'm not advocating for a recession. I don't think, we can rule this possibility out. I think just saying it's presenting on the data, I think it's something that we have to still account for, still understand that it is a possibility. And if that does happen, then of course we have to be ready for it. We have to be prepared for that possibility. Now, when it comes to equity flows that tend to be a little bit muted going into the U.S. elections, now this right here is going back as far as a lot of different election years, all the way till 2004. And what we have noticed is, apart from 2008, every single time we've seen, the acceleration in equity flows as a percentage of total assets under management. This is where we are right now. And post-election, we can expect that acceleration to happen. However, once again, recession is going to be the big question around that time frame, because 2008 was the only time we saw that number decline after the elections, because we did go through a pretty significant global financial crisis as well as a recessionary environment. So a lot of that's going to depend on whether we see a recession or not. That's what's really going to dictate the trajectory for the equity flows for the U.S. Now, this right here is the Fed funds futures. Now, switching gears over to the federal funds rate and what is the Fed expected to do. Pretty much 25 basis points, I feel like it's a done deal. I think it's really going to come down to 25 or 50, but 0 to 25, I think it's a done deal. We are getting a rate cut in September, so in about 16 days or so. But then again, the real question then becomes how big of a rate cut and what's going to be the expected rate cuts in the future. Now, I do believe that 50 basis points could actually be a little bit counterproductive for the market. And this right here is from the compound history of the Federal Reserve rate cuts. And what you'll notice is, once again, when there is not a recession, S&P 500 returns on a 12-month basis without a recession, it tends to draw down less, and it tends to actually go down a lot less times. So this right here, everything in blue, is the market's performance 12 months later after the Federal Reserve cuts rates when there has not been a recession. Once again, the markets tend to perform much better. There's only really been one instance in 1976 when we did not witness a recession. Markets were down 12 months later after the Federal Reserve rate cuts, and that was maximum drawdown of 7%. But when there is a recession, that's everything in red, although you may notice that there are many times we are still positive 12 months later, the drawdowns are more severe. We're looking at over 44%, 36% sell-off, 9 to 6%, 28, 24, 25, 17, 14. So this right here, when there is with a recession, 16% drawdown. Without a recession, only 4% drawdown. So really comes down to whether the market witnesses a recession or not. Rate cut really is going to be sort of built on the idea that, okay, 25 basis points is pretty much a done deal. Inflation's coming down, economy's strong. But if they actually end up doing 50, which in my opinion is not going to happen, but if they end up doing 50 basis points, that can serve as a bit of a counterproductive measure, because then the markets are going to get spooked by what does the Federal Reserve know that we don't? Why are they cutting more? Is a recession on the horizon? Is that why they're cutting more? And that could actually result in the markets going down than up, right? So that's kind of like my 2 cents, because as we already know, markets are very good at sensing, a recession. They're very much forward-looking because they have in the past. We've talked about this in our previous videos, as I've demonstrated. The markets tend to actually, bottom before a recession actually begins, and then top before, top before a recession begins and bottom before a recession ends. So they are very forward-looking in that sense that they are able to sense out what the economy is really doing, right? And what the Federal Reserve is really implying with those rate cuts. Now, coming over to September seasonality, and we're going to finish this video off with some September seasonality as we've already done. You'll notice that the last 10 days of September actually tend to be pretty brutal, down 1%, down 69 basis points. This is on an average and median basis. And percentage of times we are actually positive is under 40%. So the odds of us going higher in the last 10 days is actually worse than the first 10 days, as I've already discussed in my other videos as well. As you can see, the week 3 and 4 tends to actually be a lot brutal, more brutal than the first couple weeks of September. So this right here is the selling pressure. In the last couple of years, we've actually seen pretty brutal down days and down weeks here, 2022, 2023, down 4.6%, 2.9% in week 3 respectively, and then down almost 3% to as much as almost 1% in week 4 for the markets. And the average and the median losses have also been pretty strong here, with over 50 to 57% probability that we're going to be lower in week 3 and week 4. So those are really the times that you have to be careful for. However, there's also another really interesting study which was showing us the performance of the S&P 500 after a plus 5% summer. Summer months being June all the way through August. So when we are up over 5% in those 3 months, June, July, August, how has the markets performed? So this year in 2024, we are actually up 7% in those summer months. And we've got all these different months: September, October, November, and December. If you come down, we actually have a pretty good September, 13 winning months versus 10 down months. October is actually quite interesting because we are down 17 times versus 6 times that we are up. 17.6 for November and 23 for December. So November, December, there's no doubt there's going to be a lot of positivity in my opinion. There's going to be a lot of bullish sentiment. Market's going to be ripping higher. But it's really September and October that we have to really pay close attention to. And more specifically, the last few 10 days of October, so October 18th to October 28th, is when we have to really pay attention, where 419, that means only 4 times those time periods, those 10 days were higher. 19 days, those 10 days were lower. So this is the buying window. This is really the buying window, everyone, that I really want you to focus on. And that is going into the last week of September, all the way through the last 10 days of October. So really just primarily looking at the last 10 days of September and last 10 days of October. Those are the 2 times where I believe we're going to get those opportunities, with volatility, of course, as we already know, spikes during the month of September by an average or median value of about 24 to 25 is where we've been. Now, when it comes to the stock gold rotation, we have seen stocks kind of underperform gold in recent times as the markets become a little bit more defensive and sort of like preparing for a potential crisis or recession or whatever that might be. But gold definitely is seeing to be favored a little bit more. And usually when that happens, we've seen the gold run-ups begin for quite some time, because the S&P 500 has gone through these cycles where gold was underperforming for 10 years, right? So it was a bit of a lost decade for gold. S&P ripped higher, and then gold outperformed S&P for another 5, 7, 10 years, and then went sideways for 10 years again. So this could be a beginning of a new cycle for gold, as we've already talked about, and I've obviously been buying a lot of gold and been mentioning that in our Discord as well. And finally, this right here is taking a look at volatility for the last 12, 13 years, all the way from 2023 to 2011, with an average and median value sitting at well over 24 to 25. I do believe that there's one more spike in us for volatility left in 2024, which once again is going to give us that buying opportunity. It's going to open up that buying window for us in the month of September or October as well. So hope you all enjoyed this video and a complete update on the markets. Very quickly, this is right here is the lot of consolidation that we are witnessing for S&P 500, although we did bounce back higher from these levels very nicely on Friday. Push right back up, broke out of that 5650 levels, and the next target's pretty much going to be the all-time highs for S&P 500. Got a big test between the bulls and the bears. The bulls actually did win on Friday after validating that support very nicely at 5560s, and broke out of that resistance at 5640, and the next target and resistance pretty much sits at this all-time high. And of course, we got the NASDAQ also, so coming over to QQQs, also trading inside this range. Still have a little bit of work to do to break out about 476, and the next target and resistance is going to be all the way up to $487, with the support level sitting roughly here 468 for the NASDAQ. So that's where we are kind of positioned for next week. I'm getting ready to buy more in the month of September and October. So make sure that you drop a like and subscribe to the channel, and also do join our Discord and our Patreon if you want to get access to all these alerts, and we'll love to have you on board. And again, you know, we've got a very simple strategy to make money. Well, we're all here to help you along the way. And as always, happy investing. I'll see you all in the next video.